Hi, everyone. Welcome back to the channel. If you're new here, I'm Victor Lung, and today we're diving into the world of venture capital contracts, one of the most critical aspects of startup financing that every entrepreneur and investor needs to understand. Whether you're looking to fund your next big idea or you're on the other side of the table as a venture capitalist, this video is packed with insights that will help you navigate these complex agreements with confidence. So, let's get started. First, let's talk about the goals and priorities of both entrepreneurs and venture capitalists, or VCs, when they come to the negotiation table. For entrepreneurs, the big goals are pretty straightforward: build a successful business, raise enough money to fuel growth, and retain as much control and value as possible. They also want access to expertise and networks, share some of the risks with investors, and of course, eventually enjoy financial returns from their venture. On the other side, VCs are laser focused on maximizing financial returns. They want to ensure that the companies they invest in make smart decisions, participate in later financing rounds if the venture is a success, and eventually achieve liquidity, whether through an IPO or a sale. But here's the thing: while both parties care about the success of the venture, conflicts can arise, especially around control and financial returns. So, how do they find a balance? That's where venture capital contracts come in. Venture capital contracts are designed to balance the interests of both entrepreneurs and VCs. Let's break down how this works. These contracts are all about structuring financial returns, allocating control, and creating incentives. For example, VCs typically get more control if the venture faces challenges, while entrepreneurs retain more control if the company is doing well. This dynamic allocation of control helps both parties stay aligned toward a common goal, making the venture a success. And the ultimate goal for both sides? Achieving a liquidity event, like an IPO or a sale, where everyone gets paid. But to get there, they need the right mix of financial instruments. Now, let's get into the specifics of these contracts. When we talk about VC contracts, we're usually talking about terms like preferred stock, anti-dilution provisions, and covenants. Preferred stock comes in several flavors: redeemable preferred, convertible preferred, and participating convertible preferred. Each has its own set of rules about how returns are distributed and when investors can get their money back. For instance, redeemable preferred stock offers downside protection without the potential for upside participation. On the other hand, convertible preferred stock can be converted into common stock, allowing for upside participation if the company performs well. And then there's participating convertible preferred, which offers both downside protection and the potential for upside, making it a powerful tool in later stage investments. Anti-dilution provisions, like full ratchet and weighted average, protect investors from being diluted if new shares are issued at a lower price. These provisions ensure that VCs maintain their ownership percentage even as the company grows and takes on new investments. Finally, covenants and control terms define the level of control VCs have over major business decisions, like issuing new equity or making significant changes to the business. These terms are crucial for ensuring that the company stays on the right track. Preferred stock has evolved over the years, and understanding this evolution helps us see why certain types of stock are favored in different eras. In the 1970s, redeemable preferred stock was the go-to choice. It provided investors with a safety net in an era with fewer IPOs. By the 1980s, as the IPO market heated up, convertible preferred stock became more popular, allowing investors to participate in the upside while still protecting their initial investment. And in the 1990s, we saw the rise of participating convertible preferred stock, which offered both downside protection and upside potential, especially appealing to later stage investors who were willing to pay high prices. This evolution reflects the changing dynamics of the venture capital industry and the growing complexity of startup financing. So, do these payoff structures really matter? Absolutely. In theory, according to the Modigliani-Miller theorem, how you slice up the pay shouldn't matter. But in the real world, these structures create powerful incentives. They encourage VCs to add value to the companies they invest in and push entrepreneurs to aim for high payoffs. For example, a participating convertible preferred stock not only ensures that the VC gets their money back in a liquidation event, but it also allows them to participate in the upside if the company does well. This dual incentive structure aligns the interests of both the entrepreneur and the VC, driving the company towards success. To wrap it all up, understanding the terms and implications of venture capital contracts is essential for both entrepreneurs and investors. These contracts are more than just legal documents. They're tools that align incentives, manage risks, and ensure that everyone involved is motivated to achieve the best possible outcome. So if you found this video helpful, make sure to give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss out on future content. And as always, if you have any questions or thoughts, drop them in the comments below. Thanks for watching, and I'll see you in the next video.